A lot of our clients have goals to retire, those that are still working at least, to retire in their 50s, mid-50s, potentially even late 50s. And frankly, a lot of our clients have been doing the right things. They've been saving, they've been investing, they've had the discipline, they've put together a plan that addresses whether they can retire when they want to, and more often than not, they're in shape to do that. The problem is that a lot of times the accounts that people have been saving into have been retirement accounts. And really, when you retire before 59 and a half, if you're not strategic, if you pull down on the retirement accounts, you have to factor in early withdrawal penalties, which would be 10% on top of ordinary income taxes. So for people, this causes frustration. They feel stuck despite doing everything right, despite having the discipline to set themselves up to retire in their 50s. Our belief is that you shouldn't have that discipline, do everything right, and then feel that there's a barrier to retirement because of taxes or early withdrawal penalties. The good news is that there are ways to access your money before 59 and a half, but the rules are complicated, and you really need to have a plan in place that addresses your income need so that you can be strategic with trying to avoid the 10% penalty.
1, 2, 3, 4.
So, Nick, we're doing this episode for a reason. If you wouldn't mind just giving kind of a high-level overview on top of what I already said to explain why the stakes are so high, why we're recording this episode.
When we do these episodes, a lot of times we talk about how much flexibility there can be in financial planning. You have different options to course correct at different times. This is one of those few areas where that's not necessarily true. One decision or a couple decisions can lock you into a path that cannot be undone. And the consequences of those paths that are not so good can be early withdrawal penalties. They can be poor tax outcomes in terms of paying way more tax than you need to, and then actually losing flexibility for your income and tax planning in later years. So the key thing about this decision is a small mistake here can actually have a long-term ripple effect that really constrains your options later on in your plan.
So that's a teaser: early withdrawal penalties, poor tax outcomes, and then loss of flexibility. We're going to break all of that down as we go through the episode here. Ron, I want to transition to you. Somebody's in their 50s. I don't care if it's 50, 58, whatever it is. What are their options for getting income without paying the early withdrawal penalty?
So it depends on if you're working with an IRA or a 401k. I'll cover the IRA, Nick, if you want to cover the 401k. So with an IRA, you can do something called 72T. And all that means is that you take systematic withdrawals from your IRA, and you have to make sure that you follow the IRS regulations. And so as long as you follow the rules, when you pull money out, you will pay taxes as normal, but you will avoid that 10% penalty. And so what happens is that there's three methods to choose from. I'm not going to get into the detail of each method. The one that I like to use, you tie up the least amount of money and you get the most income, okay? So I'll try to give you an example. Let's just say that you have $1.5 million. And we determine through the financial plan, because you always want to start with a plan, that you can get enough income from $800,000. You don't need all 1.5 million initially.
So initially, that's the key point there. So this is not 800,000 will generate the income you need for the life of your plan, but for a window of time.
Window of time, exactly.
Gotcha.
So what you can do is you take your one IRA, you split it into two. The $800,000 one, you take the systematic withdrawals from. The $700,000 one, the second one, is a regular IRA, just let it grow. Okay. If at a later date you determine that, well, that's not quite enough money, then you can do the same thing again. With that second IRA, you can annuitize part of it and maybe move part to a third IRA, okay? So that's about the flexibility, to the extent of the flexibility you have, okay?
Now, can you just break that down just a little bit further, kind of the logistics side of it? So why is it that so you have the whole $800,000.
Right.
You know that's going to last you the 5 years or until you're 59 and a half.
Yeah, that's the role I was going to, yeah, right.
You're going to leave cushion in there so
Right.
that there's some money left over, barring unforeseen circumstances. Why does the IRS not look at the second IRA and factor that in, or the lump sum balance and factor that into the 72T rule?
Because the second IRA, you're not doing 72T. It's just a regular IRA that can grow, right?
So the one thing that I would want to say for listeners is normally the IRS is looking at total IRA balances. Let's think about required minimum distributions. It's not IRA by IRA. The IRS is looking at the total balances to determine how much you need to take. With this approach, you can separate the IRAs and you can use 72T on one IRA balance. It does not apply across the board.
Exactly. Now, the thing that you kind of you mentioned, but let me just give a little bit more detail, is that you have to do it for 5 years or 59 and a half, whatever's longer. So if you start at age 50, you have to go to 59 and a half. If you start, for example, at age 58, you have to go to 63. That's another really important rule. And if you violate those rules, then it ends up being not only taxed as regular income, but the penalties apply.
And the important note there is that for the 5 years or until you're 59 and a half, they are fixed ongoing distributions. That's the key to avoiding that 10% penalty. If you don't follow any of those, what happens is retroactively you're assessed that early withdrawal penalty.
They're fixed in the way of structure, not so much. Like some of them can change a little bit over time. Some are more fixed, but basically the structure is fixed.
Yeah. Perfect, Ron. Any other points that you want to make before we go to the 401k side?
No, it gives you the ability to retire earlier, but it's not the most flexible option.
Sure. Yeah. All right. So I think Ron alluded to it. Nick, 401k, a little bit more flexible. If you could walk us through the second method.
It's called the rule of 55. And the reason for 55 is it applies if you separate from service from your employer at age 55 or later. This applies. This allows you to access that employer's 401k plan penalty-free without having to commit to one of these structures that the 72T rules require. So because of that, there's no fixed withdrawal schedule. You have maximum flexibility to take different amounts at different times as needed, but there is the structure of it has to be your current employer's plan when you separate from service, not an old one that's just sitting out there. And the 55 or over age limit is somewhat limiting there.
So let me ask you guys a hypothetical question here. So say you have somebody that's 56 and they have $30,000 left on their mortgage. If you're doing 72T, what happens if they want to pay off that mortgage in one sweep, but they're also maintaining the fixed distributions that qualify for the 72T exception? Are they charged the 10% penalty to pay off that mortgage?
Well, if they're in an IRA and they're taking systematic withdrawals, those withdrawals probably aren't enough to pay the $30,000 mortgage.
Right, so I'm saying
right?
A one-time distribution
So
on top of 72T.
Yeah, so if you take a one-time distribution on top, that distribution would be taxable as regular income and a penalty.
Right,
Yeah.
and then the 401k, Nick, what you're saying in this example kind of alludes to the flexibility. If we decide through the plan that that's the best thing for them to do, just get rid of the mortgage, $30,000 left, they can pull that from the 401k, avoid the 10% penalty, and we can still meet their income needs from the remaining balance.
That's correct.
Gotcha. Nick, on the 401k side, I know I kind of jumped in the middle. Is there anything else that you want to add?
No, the point here is if you have access to an employer plan and you meet the age requirement, in some ways this is a preferable path just because of the additional flexibility. There aren't all these rules to comply with, but you have to have access.
Schedule your complimentary review with Ryan and his team today. Just visit them online at wyzewealthadvisors.com or call 724-271-7019 to get started. That's 724-271-7019 to get started.
So let's do just a quick comparison to kind of drive the point home. So Ron, I'll kick it over to you. If you could just compare 72T versus the Rule of 55 directly, just because the rules are complicated.
Right, they're definitely complicated. So 72T, applicable to an IRA, and it's structured pretty rigid. Rule of 55 applies to retirement accounts, like a 401k. And so what I would say is that if you have a 401k and you're retiring earlier, you may not want to roll any of it or a portion of it over to an IRA. Now, what you do is based on a plan is leave enough in the 401k to meet your needs, and maybe the other part could be moved to an IRA, but that's just based on individual circumstances. And so think of it this way, the 72T gives you access where the Rule of 55 really gives you a lot of control.
Gotcha. So, Nick, what I'm gonna kind of transition here from, I think we've covered the differences, the rules and length. I want to start focusing more on kind of the strategic planning side. So all of us working with clients, just curious where you guys see, where do you think people kind of get this wrong before they retire?
I wouldn't say so much that people get it wrong as people don't think ahead or know how to think ahead strategically. So they think, well, when I decide to retire, I'll figure it out then. But decisions they've made before that lock their options in unknowingly, like whether they choose to or not. So what you can do is often determined by decisions made well before retirement. The key things to think about here, which people in the audience can probably gather, where your money is held matters a lot when you're thinking about this issue. If your money stays in a 401k, you may have access through Rule of 55. If you've already moved things to IRAs or you move things to IRAs before you think about where you're going to take income from, you may limit your options. So if you could, and I'll underscore this, if you roll your 401k into an IRA before you separate from service or as you separate from service, before you figure out how you're going to deal with income needs, you will have lost your Rule of 55 eligibility generally. Now, some plans may allow money to be rolled back into the 401k from an IRA. There's always exceptions in our world. But you typically need to be an active employee, which doesn't help most of the people we're talking about.
The gist is that talk to us ahead of time. We'll have a plan. We'll figure out what to do based on your circumstances.
And the plan has to allow it. Is the other piece.
And the other thing that I'll add too is that it's not a standard approach with this. It really does. The way that this works in reality is it's plan first, logistics later. The reason I say that is because if you look at the 401k, yes, there's more flexibility on the income, the distribution side, meeting your income needs. However, in the 401k, there's also very limited investment options. So what we do for clients is we typically, Ron made this point earlier, we'll typically figure out how much they need for income until that 59 and a half, until they reach age 59 and a half. We don't have to worry about the early withdrawal penalty. We'll keep that plus a cushion in the 401k, meet the income needs from there. And then the remaining portion you can roll into an IRA because you get a lot more flexibility from an investment standpoint, what you have access to. Again, I jumped in, Nick, but is there anything else on the strategic planning side that you would want to add?
Just emphasis that you make these decisions and they can really lock you in to different options. So like Ron said, talk to someone well before you need to make the decision so you understand the implications fully.
Right. So Ron, I know we're getting close to the end here, but I want to further the planning topic, because not only when you retire in your 50s do you have to think about how you're going to meet your income needs and avoid penalties, but you also have to think about a lot of other things, i.e. healthcare costs being more expensive than when you're on Medicare. So can you just, can you kind of talk about that, like all the other things that people need to factor in when retiring younger?
So you always want to start with a retirement income plan. And so what will happen is that if you retire, say at the age of 50, you may be in retirement for 35 years. Someone retiring at 65 may be only 20. So because you have the extra 15 years, you tend to want to be more conservative with the withdrawal rates, because you have a longer period of time where more things can go wrong.
Right.
And so one example of that is something called sequence of returns. And so sequence of returns is, think of it this way, you retire in January of 2007, and then over the next 2 years, the market goes down over 50%. When you're withdrawing money, you could compound losses, right? So like when you're putting money into a 401k, the market goes down, you're buying low. But when the market's falling and you're withdrawing, you're selling low. Don't want to do that. So part of that is making sure you have a conservative withdrawal. Part of it is making sure that you have a well-structured portfolio that can handle it should that happen, because you don't know if it will or will not. So that's the main thing, and you want to make sure that the probability of success, that just means that you have a margin of safety is pretty, it gives you a lot of flexibility. The other things that you have to look at, as you mentioned, healthcare. You're going to be paying, until Medicare kicks in at 65, you're going to be paying extra expenses. And what's the numbers recently for like an individual, like $14,000 a year maybe?
We're starting to assume $15,000 or so,
per person,
depending on out of pocket,
right,
and what people's health is like.
So you have to make sure you factor that in, and that's a lot of money. And then you have things called like you have fixed expenses and non. So you fixed expenses may be a mortgage, car payment, whatever. The more fixed expenses you have, the less flexibility you have. So hopefully you have some things that you want to do, but if the market environment is not very conducive for that, you have the flexibility to pull back your income a little bit from other sources. So 72T is rigid, but hopefully you have some money in a taxable account, maybe in a 401k. Again, it's a comprehensive plan.
So the misconception, I would say, surrounding this topic is most people ask, can I achieve the retirement age that I'm looking for? In this case, we're assuming somewhere in your 50s. That's a really important question. That question needs addressed. We address that through the plan. However, we don't often see a lot of people asking follow-up questions once that's addressed. The next most important question really is, well, how do I access my money? And that's what we've kind of spelled out here. We're very comfortable doing this. Again, retirement, it's not just about building assets. It's about turning those assets into a reliable income stream while factoring in the tax rules, the tax implications, and when you can, avoiding penalties. So the goal isn't just an early retirement, it's having options once you get there. These are the types of decisions that we are helping clients like you think through before they retire, especially when flexibility matters most, which I would say is more often than not the case. So we appreciate you tuning into this episode. We hope you found it insightful. Please keep the topics coming in. And per usual, if you listen to the episode, you think of somebody that you think would benefit from having a conversation around this topic or any topic that we've covered in the past, please do not hesitate to introduce them to us. Thanks for tuning in.
This episode's content is for informational purposes only. Opinions expressed herein are solely those of Wyze Wealth Advisors, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.